Welcome back to Gaps Part 2. Today we're going to cover the gap up and go. So this is May 15th, 2023. I'm Mark Item from HONU Trading. First, our disclosure, educational purposes only, not recommendations to buy or sell anything. The key thing we'll talk about today is time frame and risk tolerance, because risk management is always job one. Our time frame, we're going to look at a swing trade. This is my preferred trade, where we hold something for a few days to a few weeks. Follow me on Twitter at HONU MGMT, HONU Management. So a gap up and go higher is something where it gaps up and then keeps going. So we're going to frame out a potential trade on the daily time frame and evaluate first how much risk in dollars per share. Then, if we're correct, how much potential reward in dollars per share. Then calculate how many shares using this formula, risk per trade in dollars, divided by your risk in dollars per share on this trade. So as we look at Microsoft going into earnings the day before earnings, wow, that looks pretty ugly. You've got your recent highs, your recent lows, and a sharp sell-off on high volume. But let's see what happened the very next day. Gap higher, and it takes off. So here we are, and you can consider buying this anywhere in this time frame. Let's just say we're looking at the 295 level. If it breaks below these previous highs, then that is a gap and trap. It's a failed breakout or a fake out. Exit the trade, risk $3 a share. We have no idea if it's going to work or not, but we've clearly defined our risk. Now, if we're right, this could consider going higher all the way up towards 315, 316, or maybe even higher than that. So in this case, our risk per trade, let's say, is $1,000 per share. Our risk in dollars per share on this trade is $3. So we could buy a little more than 300 shares. So let's see how that worked out, and so far, so good. It did not take out these lows, or these previous highs, and as of the close on the 15th, we're still looking at a solid trade. So in a minute, we're going to look at the intraday time frame for managing a trade, but if you find this valuable, take a moment to like and subscribe. So here is a 5-minute bar on the opening 5 minutes. Now initially it gaps higher and then starts to sell off. So again, anywhere in here, if you so desire, you could buy this with a stop beneath the 292 level. You're risking $3, and maybe you want to wait for it to come back above this level. The low risk area is to wait for it to go above the opening range breakout at 297, but now you've got $5 of risk instead of $3. Given that we've got $16 of potential reward, still acceptable. So here we are a little bit later. This is about 30 minutes into the trading day, and we're clearly above that. This has not broken down yet. So let's enter the trade, and we're risking roughly $3. By the end of the day, it's gone higher. The next day, it finally moves, and this is where you get a significant move, from the 295 level all the way up to 309. Now, that's a big move. If you want to, you can take some profits in there, but there's no reason to jump out of the trade. It has not done anything wrong. So far, it is innocent until proven guilty. And looking at a 30-minute time frame and zooming out to several days, it really doesn't take out any of these lows anytime soon. So now looking out to the 65-minute time frame, and here we are towards the close today, still hasn't done anything wrong, but hasn't made any great progress either. So far, we're still looking at a very positive trade, and that's how we can use both the daily time frame to frame a potential trade and the intraday time frame to manage that trade. So as my buddy HONU always says, keep your losers small because small losers win.